Hi, I'm Spike Hughes. I'm the founder and chief executive of INSYNERGY. What is the INSYNERGY New World Equity Income Fund aiming to achieve? Well, I think there's two types of investors. Some investors want income and other investors want growth. For income investors, we wanted a high level of income, a 4.5% yield, a sustainable income, a growing income, and the ability to generate capital growth as well to provide an attractive total return. For growth investors, we wanted to provide outperformance with less volatility from some of the world's fastest growing and most exciting markets. Why equity income for income investors? Well, the market tells us that they don't like cash because the rates are flat. And whilst fixed income has done extremely well, with inflation potentially around the corner, this could be a real threat to corporate bond portfolios, and a lot of people are looking to allocate away from bonds and into equities. The thing about equity income is it is really the only asset class that's been able to cope with and beat inflation over time. The big question is, what is the best way to access the equity income marketplace for an investor in 2011 and beyond? Why should investors consider diversifying away from UK equity income? Well, we're certainly not saying investors should stop buying UK equity income funds. The big issue is how can you achieve a diversified portfolio? And what many investors find surprising is that when they buy several UK equity income funds, whilst thinking that they're achieving diversification, what they're actually doing is buying a range of funds that are all invested in the same stocks, in the narrow concentration of stocks that pay dividends on the UK stock market. This has obviously become a bit worse more recently because what we've seen is some of the big companies like HBOS, like RBS, like BP, actually for a period of time stopped paying dividends altogether. And that had a big impact on the yield and the income being generated. So what we wanted to do was provide access to other markets that had very strong dividend paying culture and companies where they could generate income and sustainable income and growing income and capital growth as a diversifier alongside the UK portfolio. Why not just have a global equity income fund or an Asian equity income fund for international exposure? Well, we do think there's a place for both, but we also think there's a better solution. One of the issues with global equity income funds is they have 60–70% exposure to the Western developed markets of Europe and America, both of which are facing many headwinds and challenges. With Asian equity income funds, this sector typically has a quarter of the fund invested in Australia, which is a developed, cyclical, commodity-driven market, and about 40% in financials. And we think to have a quarter of your portfolio in a cyclical commodity market and 40% of the portfolio exposed to financials is a very big risk to take for an investor seeking income. Well, if we just get back to basics, what we're looking for is a high level of income, a sustainable income, a growing income, and capital growth on top. And in order to achieve that, we need to be investing in companies that have got very strong earnings growth, that have got very strong dividend growth, which ultimately will give rising income and a strong total return. And we simply think that many of the new world countries have big structural advantages when compared to the Western world. In other words, they have the wind behind them rather than tailwinds in their face. Many of the new world countries, the emerging market countries, on average, have better demographics, have younger populations, have very strong natural resources, have less debt, have higher savings, have stronger balance sheets, and are just growing at a much greater pace than the Western counterparts. And we think if we can position ourselves to have these winds behind us rather than against us, that just gives us a big advantage, as well as the new world bringing very strong diversification to a client's existing portfolio. Why Climate Benson investors? Well, they have a great brand and heritage, but they're also dedicated equity income managers. We spent many months searching the market overseas, in the institutional space, and in the alternative space. There were very, very few people that run a dedicated equity income emerging market strategy. What we wanted was someone that had actually done this with income being a key driver and quality income and growth rather than pure growth only. And our experience was that most people in this space have actually only got experience in emerging market growth, not in emerging market income. And I think that many of the launches that you're going to see over the next couple of years will be people launching income share classes where they're not dedicated equity income managers. Climate Benson are very, very experienced in the income space. Investors that are looking for a high level of income, for a sustainable income, for a growing income, and for capital return, or simply a growth portfolio that's exposed to some of the most exciting, fastest growing markets where they're looking for the outperformance that can potentially deliver, but with less volatility than the market, that is typically the type of client profile. These will often be clients in PEPs and ISAs, and in many cases will be clients in pension funds, with big retirement pension funds in SIPs, self-invested personal pensions, where they are looking for that high, sustainable growing income and the capital growth on top.